With inflation stubbornly high, 61% of Americans are living from paycheck to paycheck. This might be you. High school sweethearts Jack and Emily got together after college, but life was quite different from the dream one they'd envisioned all their lives. They struggled to make ends meet and couldn't even take vacation breaks because of their tight schedule and insufficient funds. However, before they began to increase their family size, they decided to step into the investment world in an attempt to be financially free. Join us as we look deeper into the couple's life and how the power of investing transformed their lives, leading them from financial struggles to freedom. The power of investing. The last thing you would want is for your money to devalue over time. The Andersons, like many families, were familiar with the concept of saving money. But they soon realized that simply stashing their hard-earned cash away wouldn't lead them to the brighter financial future they desired. They had to discover the world of investing. Investing, as they learned, meant putting their money to work rather than letting it stagnate. It was a game changer as their money started to grow over time. They purchased assets that increased in value and provided capital gains. Buying low and selling high became their mantra, smartly compounding their income over the years. What are some of the ways the Andersons invested their money? Types of investments. Well, the couple had always been intrigued by the idea of investing in stocks, but they were initially hesitant due to their lack of knowledge. However, as they delved deeper into the world of investments, they discovered the potential of owning shares in successful companies. The idea of investing in stocks is to buy part of a company that you believe will go up in value, allowing you to multiply your money. Hence, when you become a shareholder of a company, you become a part owner, and that comes with its benefits. What kind of benefits, though? For starters, just by owning a stock, the company shares its profits with you in the form of dividends. The dividends are like a little bonus that comes your way as a shareholder. Then, if you want to grow your investment even more, this is where capital appreciation comes in. When you buy shares at a low price and the company's value increases over time, you can sell the shares at a higher price, making a profit. It's like buying something on sale and selling it when its value goes up. Therefore, it's very similar to a snowball effect. The couple compounded their income by reinvesting the dividends and any profits made. Investing in stocks can be confusing, especially when you're new to it. So, the couple focused on companies that align with their values and long-term goals. They spent time looking for companies that have a strong track record of growth and performance over time. They researched their fundamentals, their financial status, assets, market position, and future growth possibilities. Having gained confidence in their stock investments, the couple turned their attention to exploring the world of bonds. In simple terms, a bond is like lending money to someone or an organization in exchange for interest. It's like a loan, but instead of a bank lending money, it's the investor. However, what's in it for the investor? Well, when you invest in bonds, you become the lender, and the borrower can be the government or a corporation. The borrower needs money for various projects, infrastructure, or expansions. By investing in bonds, you're providing the funds they need, and in return, they pay you interest for the loan. So, practically, it's a win-win situation. The borrower gets the funds they require, and as an investor, you receive a stable income in the form of regular interest payments. You might wonder, what if the borrower doesn't want to pay back the money? That's where the legal aspect comes in. When you invest in bonds, it's a legally binding contract. If the borrower fails to repay the loan, you, as the lender, have the right to take legal action and recover your money. Nonetheless, before the Andersons invested in bonds, they did thorough research on the borrower, be it government or corporation. They considered their financial status and overall stability. By investing in financially sound organizations, the couple increased the likelihood of receiving our interest payments without any issues. What about the interest rates? Interest rates vary among different bonds. Some offer low-yielding interest rates, but they're generally considered safer, especially government bonds. On the other hand, corporate bonds may offer higher yields, but they come with slightly higher risks. When choosing bonds, the couple aimed for a reasonable balance between the interest rate and risk. This is because a high-yield interest rate could indicate a riskier investment. Some corporations may offer high-yield rates to attract investors because they might have difficulty securing funding otherwise. As a result, investors need to be cautious and thoroughly investigate these opportunities. Jack and Emily stuck with companies with good creditworthiness and a proven track record of honoring their commitments. The Andersons realized that investing was not a get-rich-quick scheme and saw it as what it really was, a long-term strategy. Consequently, they didn't place all their eggs in one basket. What else do you think they branched into? You guessed it right, mutual funds. This offered a unique way to invest their money under the guidance of a professional fund manager. Imagine knowing where you want to go, but not entirely sure how to get there. Mutual funds step in to bridge that gap. When you invest in a mutual fund, you entrust your money to a professional fund manager who makes decisions on your behalf. But is this safe? You basically won't have control over your money. However, while you don't have direct control over the investment decisions, it can be a safer option because a professional with expertise manages your funds. The mutual fund manager takes the money from investors and creates a pool of funds, which is then invested in various assets like stocks, bonds, and other securities. And when the mutual fund earns returns from these investments, they distribute the interest among the investors. It's a way of pooling resources and sharing the rewards. But what if the fund manager makes bad decisions? This is a valid concern, and this is why it's crucial to choose a mutual fund with a reputable and successful management team. Look at their track record over the past 10 years, their performance, and the risks associated with the fund. Doing thorough research will help you find a fund manager who aligns with your investment goals and has a history of making sound decisions. Let's talk about the types of mutual funds now. There are equity mutual funds, which invest in shares and stocks of companies. They offer high returns but come with higher risks. And there are debt mutual funds that invest in debts like government bonds. These funds are generally safer and have lower returns compared to equity funds. Meanwhile, hybrid funds strike a balance. They invest in both equity and debt, offering moderate returns with moderate risks. Depending on our investment horizon and risk tolerance, we can choose the one that best suits our needs. So, how did the couple choose one? First, they researched the fund management team and their past performance. Next, they evaluated the associated risks. For the long term, equity funds might be suitable. On the other hand, short-term investments, like 1 to 2 years, debt funds may be better, as they provide lower risk and relatively higher returns. They also checked the fund's expense ratio, which is the amount the fund manager charges for maintaining our account. Most expense ratios range from 1% to 3%. They wanted to minimize this cost to maximize their returns. What about any additional fees? They were cautious about any high fee charges for being part of the mutual fund scheme, because these extra charges could eat into their overall returns. In the end, they were able to select a portfolio that aligned with their investment goal. Points to bear in mind: investing is not a get-rich-quick scheme, but a long-term strategy that requires patience, research, and informed decision-making. Have investment tips to share with others? Slide in the comments. If you're ready to start your own investing journey and learn more about building wealth and securing your financial goals, make sure to subscribe to our channel so you never miss out on investment tips and valuable insights.